Good morning, everyone. So following John and Mike's presentation, going back to John's presentation when he scared us all about social media, I'm going to talk today, start my presentation out with, I do agree with John on, I was scared of many of the stories that he shared and the use of social media in the workplace, but I agree with his comment that we should embrace social media in the workplace. People are already using it. Employees are already using it to network, establish relationships with clients, connections, gain insight from relevant articles out there. So it's part of our normal and day-to-day environment, and businesses need to accept the normalcy of social media. Step one, so how do you use social media to attract and retain clients or attract and retain employees? Well, first, make sure to have your social media presence, brand out there in the places that you should be. For instance, if you're a CPA firm, it probably doesn't make sense to be on Pinterest, but LinkedIn would make sense, Facebook would make sense. LinkedIn for recruitment. If you're trying to recruit employees or customers, you want to make sure to share articles. So that would be a good place to share articles, such as if you're the recipient of some type of award, so North Coast 99 award or some other award out there, you'd want to make sure to share that on LinkedIn. On Facebook, good way to engage employees, potential employees. If you put together a team that is developing a soapbox derby car, you want to make sure to share those experiences so that younger staff and people looking to come to your company see that you guys are engaged in fun activities. So that Facebook would be a great platform for that. Step two is to include your employees in content development and push. So if articles are being developed by your employees, encourage employees to share those articles, other employees to share those articles. How do you do this? Well, just one idea to do this, to encourage employees to share articles, to get it out there, is to offer some type of raffle. Maybe you give out a $100 gift card to, you raffle from the pool of employees who share that article about your company out there in social media. That helps your company build brand support, and you also find out the employees that are engaged with the company as compared to the employees that may not be as engaged. So you can kind of identify, what methods should we look at? Maybe reach out to Mike to figure out if there's a way to engage those employees. So once again, I'm just going to end the social media part of my presentation on if your company uses social media, encourage your employees to share content about your company on social media. If you're encouraging your employees to share that content and you're engaging them with your company, chances are they're reading those articles that they're sharing, so they're learning and they're learning about the great things that your company is doing. Now moving on to the accounting side of things. So first, now that we've talked about training employees on social media and teaching employees how to be emotionally intelligent, now how do we incentivize those key employees within our organizations? Well, first question is, how does your company reward high performers? There's the traditional methods as being, paying someone through a wage or a bonus to incentivize someone. There's also other ways to reward key employees. Have you considered an incentive to reward key employees, so high performers in the company, maybe putting together some type of vesting program that keeps them engaged with the company, so they're not getting current money today, but money in the future by staying engaged with the company? Have you considered tying compensation to changes in company value? And one method to do this, to incentivize key employees, is through the use of non-qualified plans. So your traditional retirement plan, 401k, you can't discriminate on individuals who participate in your 401k plan. But in a non-qualified plan, you can choose the employees that you want to attract, motivate, and reward, the high performers, and you can discriminate. You can select the participants that you want to participate in your non-qualified plan. The benefits of a non-qualified plan are that you get, as the employee, you're offered tax-deferred savings. So this money it will be paid out one day upon retirement age, whatever your plan document specifies. And it encourages tenure through vesting provisions. So if the employee happens to leave the company, chances are they're not going to get the full benefit of the non-qualified plan that you put in place. And I'll go into some examples to help people understand what I'm talking about. I'm just kind of trying to lay the foundation right now at a high level. So who should consider a non-qualified plan? Employers looking to retain key employees and employees looking to attract new key employees. Non-qualified plans, you often hear the term deferred compensation because that's really what a non-qualified plan is you're deferring their compensation to a later date of maybe normal retirement age. And it can be subjective, such as a supplemental executive retirement plan. So annual awards or quarterly, however you calculate those awards, those are calculated based off of performance. So you kind of figure out how that employee is performing, determine what their award into their non-qualified plan is, as compared to objectives. So phantom stock, which is also a form of a SERP, supplemental executive retirement plan. It's not based on objective. It's based off of company value. Stock appreciation rights are another form of a SERP that are also objective, which I'll go into both of these here in a little bit, explain a little bit further in detail. So the basis of awards. So under a subjective plan, a supplemental executive retirement plan, awards are based on performance of the employee. They're discretionary. If the employee doesn't perform well in a particular year, you don't have to award them anything into their non-qualified plan. If they're doing well, you can give them whatever you feel is appropriate based off of performance. Payments are typically made at the time the employee reaches the normal retirement age, and upon reaching retirement age, payments are typically at a set amount. So maybe whatever the amount of money that's put into their non-qualified plan after they reach that normal retirement age, maybe that amount that they vested is paid out over a 5 or 10 or 15-year period. So it's kind of like it's very similar to a pension plan, but we're choosing the people that we want to put this plan in place for. On looking at developing an objective award, phantom stock is a good example. So awards are based off the value of the company. Payments are typically made upon a future event occurring. If an event occurs, such as the sale of a company, the employee receives a portion of the sale proceeds based off of the phantom stock arrangement.
Is there any size company, like do you have to have a certain number of employees?
No, there's no size. You can, if you got 3 employees and you have a key employee that you really want to keep engaged in the business, you can do something like this. If you have 1,000 employees, you could put a non-qualified plan in place. Yeah.
Or the phantom stock, future events.
Yes, correct.
And when you're trying to, let's say, attract an employee, and you're saying we have some phantom stock we'd like to use in your offer, how does Apple assist with identifying the potential value of that to that employee?
So we have a valuation team, and our valuation team could help the company put together kind of a value of the company. This is where the company is at today. Based off of speaking with the owners and some of the things that we know are coming up with this company, the future growth potential, this is where the stock could be at a future point in time. And it doesn't necessarily have to be with a sale. I use the sale of a company because that's a lot of times if someone's unsure, is my job going to be around in 5 years if I come on board, or a key employee, finds out that the owners are aging, they really don't have a good succession plan in place. How do you keep that good person phantom stock, which would address the event of a sale, is a good way to keep that employee on board. So some of the benefits of a non-qualified plan include the plan can be structured to attract, motivate, and reward employees. You can discriminate, I brought that up already, meaning that you can select who you want to participate in that plan, encourage tenure through vesting provisions, and you have control over the structure based on the plan document. So your plan document, which would be drafted by, legal counsel who is qualified or aware of, Section 409A, which we'll just briefly touch on here in a few minutes. So in this plan document, you would specify, are awards calculated, tied to individual performance, or is it tied to the overall value of the company? Is it tied to the appreciation in the value of the company? And the supplemental retirement income for the key employee, it's really to supplement other savings. So, if the employee has a 401k plan, if your company has a 401k plan, this is in addition to that retirement savings. This is more money that they would receive upon reaching retirement age if the company weren't to sell or something like that. If it were to sell, that would be addressed usually in the plan document. Some disadvantages include strict language regarding 409A compliance. So 409A, it's a pretty thick IRS code section, and there's very strict language in terms of items that need to be addressed include death, disability, retirement, sale of the company, and termination, willful termination of the company of the employee. So would that employee vest in a portion of their non-qualified plan contributions or not? All that stuff needs to be addressed within your plan document. No tax deduction to the employer until paid. So if the company is looking for a current year tax deduction, you're not going to get any type of tax deduction until that money is actually paid. And in turn, the employee doesn't have to pick it up in income until that employee receives the money. So upon retirement age, that employee would have income. The company's then going to have a tax write-off. Cash is needed to pay the obligation when it comes due. So just be aware, if you have put one of these plans in place, make sure you're able to fund it one day. And it's not money today in the employee's pocket. So, some employees would rather have money today than money in the future. And that this is a disadvantage of a non-qualified plan, because you're putting money into a retirement account or into a plan for some type of future event to keep that employee on board. I'm gonna sidetrack a little bit because I heard something came out maybe a month ago, 3 weeks ago, regarding repayment of student loans. So this is a private letter ruling that a company requested the IRS to provide an opinion on where the IRS would stand if the company were to match. So say you hire a student right out of college, ton of student loan debt. This private letter ruling says that the employer can put the matching contribution into the employee's plan to the extent that they pay student loans. So for instance, if the employee's paying $5,000 a year in student loans, but not contributing into their 401k plan because they don't have money to contribute into their 401k plan, the employer can match to the extent that they put money into against their student loans to the matching percentage. If it's a 4% matching, you'd be limited to that amount. Brand new, hot off the press. It may even have been 2 weeks ago. I just read the article, but it's a private letter ruling, so it's only specific to that individual taxpayer, that individual company. They pay $10,000-$15,000 to get the IRS to look at something and say, hey, yeah, we're okay with that. If your employees can't afford to contribute to their retirement plan, you can still match it if they prove to you how much they're paying. You can still put the matching percentage in. So I only bring it up because it tells you kind of, a private letter ruling will come out. It'll tell you kind of where the IRS is going, kind of the direction, and maybe in a year or two, 10, we actually get some guidance and regulations come out to say that this is an actual thing that companies can be doing. But I,
Is there a risk that it could go away, that the IRS can someday say,
Yeah.
no, never mind, you can't do that?
yeah, it's a private letter ruling. So that when the company submitted, said, hey, this is what we're thinking about doing, tell us your opinion. It's not in law, so it's specific for this one company to do. So if it were to go into law one day, then others would be able to. But the IRS couldn't go back on this company and say, hey, you're not allowed to do this. They've already approved that this private letter ruling says that they're allowed to do it, but it's not specific to other companies. I bring it up because maybe we see guidance issued, 2, 3, 5 years from now, but it's could be something that we're able to use in the future to attract employees who have high student loan debt to our companies. A little off track there, so let me get back on track. So it's some tax considerations relating to a non-qualified plan. The employee does not pay income tax until awards are received. So if the employee reaches full retirement age, awards are received, employee's gonna pick it up as income, the company's gonna then get the tax deduction at that point in time. When the awards vest, their FICA tax, Social Security, Medicare, and city income tax are gonna be due on the vested portion of those awards. So they're not subject, let me take a step back, they're not subject to federal or Ohio income tax until paid out, but at the point that the awards vest, at the point that you say, hey, this employee is going to receive this amount of award at a future point in time, that's subject to Medicare, Social Security, and city income tax. And it's subject to these payroll taxes at the net present value. So if the employee's 30 years old now and your plan says at age 62 and you award $10,000, that the net present value of that $10,000 is probably pretty minimal, looking 30 years in the future. The vested portion of a SERP liability award, it becomes a liability of the company when the award vests. So on the financial statement, it's going to sit there on the balance sheet as a liability at the vested net present value of the vested portion. And there's no requirement to set up a separate account to fund the liability, but I would say this is a good practice, especially a good practice if you're sharing those financial statements with your key employees. I know, people want to get the warm and fuzzy feeling that the company actually has the money to pay them one day in the future. So I'll see a lot of companies that put non-qualified plans in place. You'll see the liability, and maybe you'll see an asset on the balance sheet, money set aside in some type of account. Why is it important? Because the SERP liability is subject to claims from creditors. So if the company were to go under, your retirement account just disappeared. So, which is why companies looking to put something like this in place, if they're sharing financial information with these key employees, these participants in this plan, they might want to see that you're actually funding their SERP non-qualified plan liability to be paid at a later date. In terms of funding, you can set aside assets of the company. Assets set aside, once again, subject to claims of creditors. You can fund this through life insurance, mutual funds, money market, however you want to fund it. If you have a couple of key employees and you want to take out a life insurance policy because if something were to happen to them, you want to be able to fund this SERP liability. Perfectly fine to do, assuming sign-ups from the participants. But as a reminder, there is no requirement to fund the future liability. It's going to sit on the company's books as a liability, and whether the company decides to have a offsetting asset is completely up to the company and at the company's discretion. What documents are involved in setting up a non-qualified plan? Well, you're going to have to get your legal counsel, someone like John from Myers Roman involved to help set up your deferred compensation plan and supplemental pension plan. These agreements really explain the terms of the plan. So this is where you kind of draw up what you want your non-qualified plan to look like. The participant beneficiary designation form should be provided. So basically all the key employees, the participants in this non-qualified plan should spell out who they want to receive their vested portion of their awards should something happen to them. You know, there's something called a top hat filing, which registers the plan with the Department of Labor. So your 401k plan, you know, you got that 5,500 filing, you file it every year, you tell the IRS. Well, the top hat filing is a one-time filing. You're letting the IRS know that, hey, you have this retirement plan, this supplemental retirement plan in place, and it's not, it's a one-time filing to register with the Department of Labor that you have a non-qualified pension plan in place. There's no annual filing. You don't have to tell the IRS regarding what your annual awards are or anything like that, but it's the piece that registers it to make it legal. The certificate of awards or value, they probably should be distributed annually or in accordance with the plan document. If your plan document says, hey, we want to, you know, award an employee on a quarterly basis, then you would go ahead and put together this certificate of award or value. So basically what this is going to be is a piece of paper that says, hey, you know, let's say Joe receives, you know, an award of $10,000 into his supplemental retirement plan, and it's going to be signed by the owner or whoever the authorized individual of the company is, and signed by the employee to, you know, say that this is a legal document that this employee now has $10,000 set aside for them at some future date. FICA and city taxes are due at the time the awards vest at the net present value, so your accountant's going to have to be involved to make sure, or payroll provider, to make sure that if the awards, you know, let's say it's $10,000 to be paid out, you know, 30 years from now, but $10,000 is the vested portion, maybe the award's higher, who knows. And I'll go through an example to kind of explain this. It's got to be subject to, the vested portion is subject to Medicare, Social Security, and city income tax at the time the award vests. And I think I hit on a good benefit of, you know, having a non-qualified plan in place is if you have a individual who is maxing the Social Security limit of $128,400, then that award would only be subject to Medicare and city income tax. So when that individual then retires and they start receiving these awards, you know, they're only paying federal and Ohio income tax on the awards. So basically, if you're over $128,400 in wage, the vested portion of your future awards, they're going to be subject to probably just Medicare and city income tax if you're in a taxing city. Payments, when awards are paid to the individual, the payments are reported on W-2 subject to federal and Ohio income tax. The employees include this as ordinary income on their tax return, and the company can then claim a tax deduction. Here's an example, and okay. So in this example, we have an employee who, at the age of 47, the SERP plan went in place. This was 2014. First year, the employee, this is a subjective plan, right? Yeah, subjective plan. So the company decided to award the employee $15,000, and the $15,000 in the first year, the employee vested 10%. So $1,500 was this employee's cumulative vested amount after the first year. So had the employee sign a document saying that, hey, you know, here's your $15,000 award, but you're only entitled to $1,500 of that award after the first year. So the amount in payroll that we would include, and it's actually the net present value of the actual payout at age 65. I'm just trying to make this easier in the example. The amount reported in payroll was $1,500, but it would be lower since, you know, the award would actually be paid either at age 62 or 65, normal retirement age. So every year, the employee receives these awards, and the vesting percentage based off of this employer's plan document increases At age 50, the vesting portion increases to 50% of all awards. At age 62, it increases to 80%. And at age 65, it's 100%. So if the employee stays till age 65, they're going to get 100% of money that has been put into their non-qualified CERP plan. If they were to retire at age 62, they're going to get a payout over 5 years of $2,070 per month based off of awards through 2018. And if they were to retire, if no other awards were to be provided, if they were to retire at age 65 and no other awards were to be provided, they'd get $2,995 in retirement paid out over a 5-year period. So this vesting percentage is really up to the employer to determine, how you want to design it. So if the vesting percentage maybe is pretty low until a certain point in time, and then maybe it steps up to make it so that it's more of an impact to that employee. If they were to leave your company, they're going to be leaving a lot of money on the table. Now looking at phantom stocks. So phantom stock is another type of non-qualified plan. It's hypothetical shares of a company are assigned to the plan participant. So the phantom stock can increase and decrease in value based off of the company's share price. And typically phantom stock plans fall into two categories: appreciation only and full value. So appreciation only, you would set the value of the company at the time the plan goes in place. So say the company was worth, the employees' percentage ownership was worth X. If the shares grow to some other number, that's what the employee would be entitled to upon, some future payout. Full value plan would be based off of the entire amount of the company, entire value of the company. Some additional benefits of a phantom stock plan, an objective plan, would be that it's based on overall performance of the company. There's no investment required by the employee, and the shares of ownership are not diluted. And why this might be a good idea is based on the overall performance of the company, so that the employees not only aspire to do well, to perform at a high level, but they're trying to encourage growth of the company. So that's an additional benefit of the use of phantom stock as compared to subjective CERP. And they also, they can't argue over the value of the company. If you were to award them some award, how'd you come up with that value? Well, it's based off of a calculated amount. Additional disadvantages would be for appreciation-only plan, participants may not receive any award if the stock doesn't appreciate. And an appraiser may be needed to value the company. This could be avoided if you put an equation in the plan document. Maybe you said that the company, if it, we're going to value the company at 5 times EBITDA, well, you can calculate what your earnings before interest, taxes, depreciation, comes out to be based off of your tax filing or financial statements. And this is just kind of so I'm gonna dive into calculation of value next, and the next example is an appreciation only plan. So here we have an employee who was awarded 5%. Who was awarded 5% of the company, and the company was valued at $9 million at the time the company was awarded the phantom stock, and we're calculating that based off of EBITDA minus the debt of the company. So we're coming up with a value of $9 million. The company was given a 5% share. Well, I'm sorry, that was our starting point, was $450,000. The individual's ownership of 5% of the company was $450,000. So the growth over $450,000 would then go into the employee's non-qualified plan. So as the company continues to grow, the employee's gonna get 5% of the growth, and in this example, the company grows 10% year over year, and 10% year over year. The cumulative award in the first year that the plan is fully in effect, the individual would get $50,000 into their non-qualified plan. After 10 years, that amount could grow to almost $680,000, assuming that the net value of the company is increasing 10% year over year. Any questions? No, that. Yeah.
Okay, if there's no department to set up funding for the plan, then how is there an incentive? The employee just said, we don't have the money, sorry, the money is there for you, now you're ready to get back. You get it.
Well, that employee would become a creditor of the company. So, absolutely. That's the reason why it's important to have the Department of Labor filing, is now the employee's a creditor of the company just like every other vendor of that company. So, there would be legal action that you could go after your employer if you have, if you've reached whatever age according to that plan document. Any other questions? Yeah.
Question. I'm familiar with the phantom stock, but what is profits interest?
So a profits interest is typically in a partnership. An individual doesn't have an equity interest, and this would be spelled out in the operating agreement for the partnership. And it's different than what I'm talking about today. So profits interest would be, say a company earns $100,000, you have two owners in the partnership, they each retain their 50% equity interest, but they want to incentivize a key employee. So these two owners give 10% interest, each give 5% interest. So on their K1, when this company that earned $100,000, the two 50% equity owners, 45% profit owners, would each have $90,000, $45,000 and $45,000. That profits only interest would get $10,000, which would be payable at some point in time, because a partnership's not required to distribute their income unless their operating agreement says so. But that individual is going to pay tax on that profit currently. So the difference in, so that is an incentive to keep employees. However, that employee is going to pay tax on that income currently, and they may not get the money distributed. And then if that employee then leaves the company too, you kind of got to wind down, change the operating agreement, wind down that profits interest. They don't own any of the stock, but yeah, go on. Any other questions? If you have any questions, feel free to reach out or shoot me an email. I'd be happy to help. All right, thanks.